DSCR loans are one of the most powerful tools in real estate investing. Many people are unfamiliar with the product and how it works, so let's break it down completely. By the end of this, you'll know what a DSCR loan is, what it takes to qualify, and why investors choose them over conventional loan products. Let's start with the basics. DSCR stands for Debt Service Coverage Ratio. Instead of asking, can you, the borrower, afford this loan, a DSCR loan asks a different question. Can the property afford itself? It does that with one simple ratio: the property's rent divided by its principal, interest, taxes, insurance, and association dues if applicable. If the rent is higher than that full payment, your ratio is above 1.0 and the property is carrying itself. Lenders generally like to see 1.0 or better, and a stronger ratio, say 1.25 or higher, unlocks better terms and higher leverage. Some lenders will even go below 1.0 with adjustments, but that's no ratio territory. What can you actually buy with a DSCR loan? It's flexible. Single-family homes, condos, warrantable condos especially, and 2 to 4 unit properties all work. The common thread is that it's an investment property, which brings us to the requirements. Here's what it actually takes. First, it's for investment property only, not the home you live in. It's built for rentals. Second, most lenders want you to already own a home. Some will work with a first-time investor, but the typical box wants a housing history. Third, plan on 20 to 25% down. DSCR purchases generally go up to about 75 to 80% loan to value for strong borrowers. Fourth, your credit score still matters. You're not using income, but a higher score unlocks higher leverage and better terms. Fifth, and this is the whole point, no personal income is used. No tax returns, no pay stubs, no debt to income ratio. The property's rent does the qualifying. Sixth, you'll usually need some reserves, a few months of that PITIA payment sitting in the bank. And seventh, if you've had a bankruptcy, lenders want some seasoning since the discharge, often a couple of years, and it varies by lender. One more thing people miss. Most DSCR loans carry a prepayment penalty because they're investor loans. It's usually a step down over the first few years. Know your hold strategy before you sign, and in many cases, you can buy that penalty down or out for a slightly higher rate. So here's the big question. Why would someone who could qualify for a conventional loan choose DSCR anyway, even under the conforming limit? 3 reasons. 1, it doesn't touch your personal income or debt to income, so it keeps your borrowing power open. 2, you can close in an LLC, which most serious investors prefer for liability and privacy. And 3, there's no Fannie Mae cap stopping you at 10 financed properties. DSCR scales with your portfolio. For an investor who's building something, that flexibility is often worth more than the conventional option. That's the complete picture. A DSCR loan qualifies the property, not you. If you've got a deal and you want to know whether it fits, send it my way. DSCRinsider.com